What's going on, everybody, and welcome to the video. As you can see, I'm on the well-loved and hated Robinhood. In this video, I want to talk about options trading. I'm going to use Robinhood as my example. I'm going to teach you buying calls, buying puts, and selling calls and selling puts, and kind of just all that I can teach you about options in a short and simple to explain matter of time. So if you enjoy my content, please subscribe to my channel and turn on post notifications for all of my future videos. And let's just go ahead and kind of get straight into it. So my example today is going to be used on Apple. So I'm just going to go ahead, and you can see here it says trade Apple options. I don't use Robinhood. I have 12 cents in my buying power. So I'm just going to go ahead and show you to do options. You have to kind of get approved on Robinhood. Just go to your account and kind of get, say you know options a little bit if that's really how you want to get it, because then they'll let you trade options. You don't have to say you're a professional. You just have to say you know what they are, basically. So a little bit about options. This is what it's going to look like. All options expire on Fridays. So today's June 28th, expires today, July 5th, July 12th, and you'll see the pattern goes on and they all expire on Fridays. So I'm just going to use next week, July 5th, as my example. And you can see you can buy a call, you can buy a put, and you can sell a call, and you can sell a put. Now, let me go ahead and kind of tell you some key terms that you really need to know. So first off is the strike price. You'll see here the asking price. This is how much you have to pay for the option. So it's this number actually times 100, because one options contract holds 100 shares. So an option is literally just a asset that you can buy, and it helps you make magnified returns on a stock. So let's just go ahead and explain this. The strike price. Right now, Apple trades for $211.66. The strike price is right here. This is the price that if you exercised your stock, you would either buy or sell 100 shares of that price. So when you buy a call, you want the stock price to go up. Buying a call, you want it to go up. Buying a put, you want it to go down. So hypothetically, the stock price is $211.66. Let's say I bought this option at $212.50. All right. It expires on July 5th. That is your expiration date. This is the day that your option expires. It's always on a Friday. You have to either sell your option or you have to exercise it on or before this day, or really it's just going to go to waste. So let me talk about the strike price. With a call, the strike price is going to be the price at which you can buy that stock. So let's say Apple, for some reason, just went berserk. Okay, I'm going to go ahead and just draw a chart. Let's say Apple went like this, and it traded at $220. That $212 strike price, what that means is even though the market has the shares for $220 a share, because you bought this option, you can exercise your option and buy 100 shares for $212.50. So hypothetically, 220 minus 212.5, you'd make $7.50 per share times 100. You would make $750 based off this option. Now, options also make money because they are very volatile. So let's say you bought the call. Okay, you can see just today, because Apple went down 1.14%, the value of the option went down 59%. But what about the puts? As I said, puts, and they go down, the stock price, you want the stock price to go down, so you buy a put. If you had this option and you were holding this $212.50 option, today your position would be up 94%. Okay, options are very volatile. So hypothetically, a lot of people go into the market, they buy an option because they think that the stock price is going to go down or go up in a short amount of time, and they make fast returns. So there's pros and cons to it, because the con is, well, what if you thought it was going to go up, but it actually went down? You lost 59% in a short amount of time. So that's the downside. They are very risky. Understand that. And you also want to know exercising. So a lot of people, like I said, they buy the option for $160, because remember I said it's times 100 because each option contract has 100 shares in it. So instead of 1.6, it's actually $160. So you times this by 100. If I paid $160 and I think that the stock price is going to go up, and then let's say it goes up 200%, instead of my option being worth 160, it should be worth, quick math, $480. Okay, so that's how option trading is. But then you can also exercise it, where you buy the shares at $212.50 and even though they're more expensive, and you make profit by actually buying the shares at cheaper. So that's options trading. I explain it as best. It's a derivative. So you buy an Apple call, you can buy them on Microsoft, you can buy them on any company for the most part, as long as they trade on enough volume and there's an options market for them. A penny stock that is worth $2 million is not going to have options on it. It's just very rare because nobody wants to put that much risk into that company. So let me go ahead and teach you a little bit more. There's different profits because you can buy a call, sell a call, you can buy a put and sell a put. So with the profit on buying a call, the formula is the stock price minus the strike price minus the premium paid. So in the example I gave you, $220, let's say the stock went to $220. Let me actually just drag myself around so I can redo this. Okay. Here's a big chart. Price. And this is the stock. Okay. Went to 220. This is you bought a call. And your strike price, SP, is 212. I'm just going to do 212 for simple math. And it's easier to, please excuse my terrible handwriting. Also, subscribe to my channel if you like my video. Thank you. But yeah, so your profit on this would be, you can see stock price minus strike price. 220 was the stock price. 212 is the strike price, just for simplicity. So you made $8 per share. Remember, options are worth 100 shares. They always are worth 100 shares. They're never worth 10, never worth 50, never worth 77, always 100. So you made $800. But remember, you also had to buy that option. So how much did the option cost you? If I bought this today, it would cost me $160. So 800 minus 160, quick math, I believe that is $640. That's how you make profit with an options call on buying a call. Now, what if you bought a put? Or what if you sold a call? Okay, this is when you're on the other side. So instead of paying $160, you're actually going to be getting $160. So I want to sell a call. I want to sell it for the 212. So you know what? I'm going to actually have to unclick this, and I'm going to sell this. Okay, now the reason why it's different is because the bid and the ask spread. Sellers want to get 160, buyers only want to pay 125. So if I wanted to get it executed right now, I'd have to sell it for 125 bucks. So what would happen is this 125 bucks would get put into my account, and that is the maximum amount of profit I can make. Okay, my maximum amount of profit when you sell a call, it's the premium you collected. Now technically your downside potential is technically unlimited, but that's if you don't own 100 shares. So whenever you sell a call, you need to own 100 shares of the stock. Because if somebody who's on the other side of that option exercises and you don't have 100 shares, you're going to have to go buy those shares at the market. So you have to deliver on those shares if they get exercised. Now remember, it's an option. There's no demand that when you're the buyer of a call or buyer of a put that you have to exercise. You don't have to. You can let it expire worthless. You don't have to. It's an option to buy or sell those shares. But when you're the seller of it, you're kind of obligated to deliver upon what you said you could do. So if you sold a call, you have to be able to deliver those 100 shares. If you sold a put, you have to be able to buy those 100 shares. Okay, so with the example, sold a call. You made your 120 bucks. Okay, plus $1, $120. And let's say the stock, what you want when you sell a call is you want the stock price to go down. Okay, because hypothetically, if it goes down, you'll get 125 bucks. You won't have to pay any difference, as long as you don't get exercised, because as long as the stock price stays down, if it stays below the strike price, you want the stock to stay below the strike price. If it does, there's no reason for the person who bought that call from you to exercise on the stock, because why would somebody pay $212.50 whenever the share price would be, let's say, $211.66? Why would somebody exercise? Why would they pay that extra money on the price of the stock when they don't need to? It doesn't happen. Okay, so you want it to stay below the strike price. And if it doesn't, that's when you start to maybe lose money, because the difference in maybe the price you paid for the stock and things like that. But the overall formula is the premium you received minus the stock price minus the exercise price. So for example, if you got $200 in selling premium and the stock price was at 10, the exercise price was $9.50, you multiply these by 100 because 100 shares, your profit would be $200 minus 50, so you got 150. Okay, remember, your maximum profit is a premium you collected. Your downside potential is technically unlimited. Now let me tell you about buying a put. Buying a put is when you want the stock price to go down. You want to see the price go down. It's kind of the same as buying a call, but the other way around. And instead of being able to buy shares for cheap, you get to sell shares for expensive. So let me show you. Buy put. So what you want is for the stock price to end below the strike price. So let's say I think Apple is going to fall below $210 in the next week. Okay, so what I would have to do is I'd have to pay this $184, okay, to get that option. And now what that gives me the right to, but not the obligation to, it gives me the option to, let's say Apple fell to $205. Instead of going into the market and paying or selling my 100 shares for $205, you usually buy a put when you already own 100 shares. But let's say I owned 100 shares, and instead of going into the market and selling for $205 a share, because I paid $184 in the past for this option, for the $210 strike price, I actually can go and be like, hey, you sold me this, I bought this put from you, so you owe me the right to give me shares for $210. So now I get to sell my shares for $5 more per share in the market. And that's kind of what buying a put is. It's very simple. These are very simple ways to make money if you do it correctly. They're not money glitches, but I'm just explaining options in a very simplicity way, in my opinion. And then the last, technically the formula for this is strike price minus stock price minus premium paid. So you pay $200 for an option, stock price in at 7, but your strike was 10. So $1,000 was your total premium, or total strike price. So $10 times 100 shares, $1,000 is your total strike that you get to sell your shares for, minus the $700, which is the stock price. So let's say you went into the market, you bought $700 worth of shares, so you paid $7 a share for 100 shares. Then now you're left with $300, but you paid $200 for the option, so your profit would be $100. When you buy a put, your profit is technically unlimited. Your maximum potential profit. Your maximum potential loss is only the premium you paid. You can never lose more. Okay, and that's as long as you're doing it correctly. As long as you're not doing any naked calls and puts, which we won't talk about necessarily. But it's basically when you sell a put or you sell a call, you can have these naked puts and calls when you don't own the shares. You don't have the money to buy the shares. So that's a little bit different. But let's talk about selling a put. Okay, the selling a put, the premium you receive minus the strike price minus the stock price. So let's say you want when you sell a put, you want the stock price to go up. So let's look at Apple. Let's say I wanted to sell a put. Okay, I want Apple to go up, but when you want it to go up, you want it to go up within a certain range because you don't necessarily want to be exercised. You want to just collect the income. Now, people trade differently. That's just the most common way is when you trade it, you want it to, let's say this is a $220 strike. You want the stock to go up, but you never want it to pass this level. Because if you do, there's a chance you get exercised. But if you do it correctly, you can make it a way to collect some pretty good money. So if I sold this put right here, let's say I sold it for the 220, okay? I could sell that for a lot, $835. Yeah, but what's the risk? Well, let's say Apple stock actually went above $220 and it went to $225. Sorry for my terrible handwriting. Let's say it went to $225. What happens next? You get exercised, and now you have to pay $225 per share for 100 shares. Okay, 225 times 100. I can't do that quick math. $22,500. That's how much you have to pay if it goes up and you get exercised. So that's the risk with selling a put. You want it to go up, but you never want it to go past that level because then you could get exercised. Now, if you want to just be like, I'm willing to pay for this price, then you get to do that. You actually, yeah, that's if you didn't own the shares. Sorry, I'm all over the place right now. If you didn't own the shares, you'd have to go buy them for $225. But if you own them, you just have to sell it for $220 per share. So technically, if you bought the shares in the past for $150, and you're okay with selling for $220, like, go for it. Sell that put, collect that premium, collect that income. So that's selling a put. But remember, if you sell it, you need to have enough money to buy 100 shares of the underlying stock, or you just need to own 100 shares. Because otherwise you can get in some pretty big financial trouble. So keep that in mind. That's a very big thing to understand. So when you sell a put, you need to know that. You need to have the money. When you sell anything, when you play with options, just have the money to cover your A in the event of the worst. So keep that in mind. But yeah, the formula is the premium received minus the strike price minus stock price. So you got $300 for selling a put. Strike price is $15, and stock ended at $12. So yeah, if the strike price is $15, stock ended at $14, you made $300 from selling the put, okay? And you subtract the strike price and the stock price, so you paid $15 is the strike price. So 15 times 100 shares, 1,500, and the 1,400 comes from $14 that you paid times 100 shares. So $100 maximum, that's what you lose. Your maximum profit is not technically unlimited. Your maximum profit is the premium collected, and your max downside potential is technically unlimited because if the stock kept falling and you had to go buy them, whatever. But that's options trading at its finest. Hopefully you learned something. If you did, please subscribe to the channel and turn on post notifications so you don't miss on any of my future videos. Thank you again for watching this, and leave a comment down below, and I will see you at the next one.